Alright everybody, welcome back to the Simple Markets channel. My name is JB. We're going to be going over a winning trade position that I took this current week, but I'm also going to be doing a top-down analysis on this pair all the way from the yearly time frame straight down to the 4-hour time frame, which is where I took my entry. Now before we get into it, I do want to preface this video by saying these concepts I'm going to be using in this top-down are not something that I use on an everyday basis to take the trade. One of the main things we focus on here at Simple Markets is a mechanical and very consistent, repeatable trading plan. So the topics I dive into today, like volume, liquidity, or structure, although they are used in my trading plan, it doesn't mean that I'm doing these extensive top-down analysis every single time I take a trade. And I want to make that very clear just so you guys understand that this complexity that you may see in this video, or the breakdown I do overall of this pair, is not something that needs to be repeatedly done. But without further ado, we're going to get right into it here. We're going to take a look at EURUSD on the yearly time frame here. And one of the first things that I'm going to point out is your structural order flow that we have here, where we have a higher high, a higher low, a higher high, followed by another higher low, and then another higher high. Everybody here should understand the basic ideas of structure. If you don't, I will link my structure masterclass video in the top right corner here. But overall, we have a break of structure that occurred. So as we know, the markets are fractal, and these concepts of structure, liquidity, volume, etc. are happening on all time frames. My trading plan that I use on the 4-hour time frame also could work on the yearly time frame like we're going to see here, and could work on the 1 minute or seconds time frames if you are an extreme scalper. But overall, the way I would have entered this trade is I would have taken a entry at the low and then a target at the high. And of course, for me, if this were a 4-hour time frame, it would be considered a missing trade and on to the next. However, I just want to point that out because I do think it's important to see the fractal nature of the markets and understand that these setups are occurring on multiple time frames. So after we see this break of structure, price makes a retracement. We actually grab some internal liquidity here, right at this low. And internal liquidity is something I talk about a lot, or consolidation, where we see price consolidating in this general range. We see an aggressive push through it, grabbing liquidity, and then we see a break of structure to the upside right here. That break of structure, more importantly, is very high volume, which we're seeing from these strong bullish blue candles here. And what I like to do is actually mark out my fair value gap here, and I can extend that out to the right. And once all of these rules are met, I am actually able to go and take my trade from the low of the range to the high of the range, and then set my order here at the 75% and target the overall high. Now, due to how many years this trade might take to play out, it's not something I'm going to be involved in, but I'm just showing you that the same exact entry model I use on the 4-hour time frame is applied here on the monthly or 12-month time frame. But more importantly, we need to understand that from a perspective of bias, my overall assumption of the market is that we will be moving from this current candle or year that we're in and making an attempt to make a run for these overall market highs within many, many years from now. So we're going to take a second to dive down to the monthly time frame here. And we're going to just kind of dive into this general range that we're seeing. We just marked out this liquidity. We just made the retracement. Now we're going to focus on this piece here, which actually, for some of you who may not know, this is what is called Wyckoff, and it's actually a Wyckoff accumulation. Now, I don't dive too much into Wyckoff because I think it can be extensively simplified from what the original theory was from Richard Wyckoff back in the 1930s. But the overall idea of Wyckoff theory is that there is some form of liquidity, typically in the form of consolidation, and there's a lot of orders that rest below that area. Many of you may know this as equal highs or equal lows even. And then price aggressively runs those lows, absorbing the liquidity in the markets and then utilizing that to then drive price in the intended direction. So we are actually seeing almost this identical scenario occur here, where we have the consolidation period with many liquidity lows here, and then price is driven heavily through it, mitigating an old area to the left in the previous range that we had, and then following our market expectation of running these eventual highs in many, many years. So with this general idea of Wyckoff theory, I am able to expect that more likely than not, we are going to be targeting these highs in the market to eventually go and target these highs overall while staying within this general range that we're seeing here. I think the important part to understand from this is, yes, despite the break of structure that we're seeing here, and that some people may assume price is bearish, because we are utilizing that top-down and higher time frame analysis, this is what actually helps you increase your accuracy overall in the market by following that higher time frame expectation and understanding that despite there's a structural break here, we're more likely than not going to see EU push bullish and try to run this target high. So now I'm going to actually mark this as liquidity, and with that out of the way, we can drop down to our weekly time frame. So very similar to what we just saw there, we're going to look at this general range that we're working within. Now, of course, when the market is ranging sideways like this, it can be difficult to follow. One of the main things that I personally focused on is this run on liquidity here. We have just a few wicks below this. We ran this market liquidity, and then we started moving bullish in price. And then we're also seeing these repeated grabs on liquidity, like so, followed by breaks of structure that are occurring in the market, and overall keeping that bullish bias that we have on the higher time frame. So when you're operating within a range, yes, it can be fairly difficult. We're seeing these liquidity grabs and we're having these targets that we expect price to reach. However, when you look at it from a higher time frame perspective, you can see something like this is a very significant high in the market. This is also what we know as internal liquidity. And if I go and mark out this internal liquidity here, you can see that it was actually just taken by price action, and then we're seeing some form of a bearish reaction. This is very common because institutions or just large-scale capital traders in the market typically put their stop losses above or below significant highs within ranges. And when we know a lot of liquidity or orders rest at a certain high or low, once that area is met, we will see a reversal or reaction from price, and that is what we're starting to see here. So we're going to take one step further and drop down to the daily time frame. Not too much to go over here simply because I just went over the weekly and you can see a very similar trend occurring here. But overall, we have this run on liquidity. We grabbed it and now seeing a very bearish reversal. Some of you may be familiar with ICT concepts, for example, and those of you who are, you may be marking your fair value gap and trying to take an entry off of the trade somewhat like this. However, I'm going to show you how I personally enter. And the only reason I do mention this ICT entry is because I want some of you to realize the similarities among the SMC space and YouTube. Some people have this idea that one channel is right, one channel is wrong, when in reality, they're all essentially doing the very same thing, utilizing the same concepts, just looking at it in a slightly different way. So despite some of the ICT traders entering at the fair value gap, I myself have a little bit more of a simple trading plan, and I like to focus on just a few basic rules. We see the liquidity sweep that occurred here, especially on the higher time frame, and then we see a break in structure to the downside, like so. And for me, all I did was take my range high and my range low after the liquidity sweep, after the break of structure, and showed a fair value gap. And I just like to put a 75% fib from the high to the low, and then take my entry right about there. Now, if you go back to the beginning of the video, the important thing to realize is that we saw those exact rules met on that 12-month time frame. We saw the liquidity sweep, the break of structure, and the fair value gap, and that gave us the bias that EU was going to come into a position and then run towards target of the range. And we're actually just doing that same exact thing here. So I will play out price a little bit. I took this trade live, so I can tell you it did run a little bit lower, so I will have to adjust my Fibonacci once it gets to its immediate low, which was here. So I eventually dragged out my position like so. I typically do that when I see trades running further and creating a larger range, and that allowed me to kind of drop my entry to this level now, and then still targeting that overall end of the range. I'm going to drop the speed a little bit here and play it out. A little too low there. Let's go here. So price was making its way to retrace into my zone, and very, very quickly we see a bearish reaction. Now, for those of you that understand what spread is in the markets, spread is when you are entering a position in foreign exchange, there is a discrepancy between buy and sell positions. And what that means is in a sell position, your entry, even though it's a little bit higher than where price reached, I actually did get tapped into this on MT4. However, the one issue with spread is it does work in the opposite direction, meaning if you had a buy position, you would not be tapped in until price is a little bit below that buy position. But spread works in the same way and actually does help you in sell positions. So overall, I was able to get tapped into this entry, and then very, very quickly, price made its run for that overall low, and I was able to make a 3 risk to reward target here. This trade was taken on my personal account, and I do risk 2% on my personal account. And if you did watch my trade video breakdown from last week, I took an AUD USD loss, as well as a GBP AUD win. So with that combined at a 4% gain, and this trade being a 6% gain, I'm actually up a significant 10% this month, which is fantastic considering it is the 9th of September as I record this video. For those of you who may be risking a little less, let's say if you're in a prop firm evaluation, you could be up about 5% on these same positions if you were risking 1%. I'm just able to take a little bit more of an aggressive approach because I do trade personal capital. Overall, I hope you guys enjoyed this top-down analysis on Euro US dollar, all the way from the yearly time frame down to my time frame of entry, as well as some insight into this winning position I took and seeing the similarities of the rules from this video as well as my last one, and even just seeing how the fractals of the market work all together. Thank you guys all for watching. I appreciate you tuning in. Like the video if you enjoyed it. Feel free to join our community. The link will be in the description, and I will see you guys in the next video.